You won't be surprised to hear that most people simply aren't in a good financial state. In many cases, it's actually quite the opposite. Either they have poor money management skills, their income isn't high enough, or both. These statistics are worth taking note of so you can avoid becoming one yourself. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. People spend more money when using credit. Research shows that consumers spend substantially more money when making a purchase with their credit card than when paying for an item in cash. Cash is a tangible item with perceived value, and when you spend it, there's more emotion involved in the process when compared to inserting a piece of plastic and agreeing to numbers on a screen. The fact that there's a delay between when you spend the money and when the money is owed, and the fact that you have the option of whether or not to pay it right away are part of the equation. For example, if something comes up and you don't have the money to pay the bill in full, you can just make the minimum payment. The concept of credit card rewards is also designed carefully to increase spending. Consumers often use credit card benefits to justify spending more money, or at least make the purchase sting a little less, resulting in more money spent without really noticing. 56% of Americans can't afford a $1,000 emergency. Only about 4 in 10 people in the United States actually have enough money to cover a $1,000 surprise expense. This means more than half of people would need to find alternative ways of paying for a car repair, unplanned doctor's visit, or other unforeseen expense. In the days of high inflation, $1,000 doesn't go far at all. Consider that the average car repair is between $300 and $500, and a root canal could easily surpass $1,000. With no money available, most people would be forced to seek other options to foot an unforeseen bill. According to the study by Bankrate, 20% of people surveyed would charge the expense to credit cards and try to pay the balance off over time, even if it means paying a 20% interest rate. 15% of respondents would try to come up with the money by reducing expenses elsewhere in their budget, and 10% would borrow the money from friends or family. 20% of Americans don't save any of their income. With the current high cost of living, it's really not surprising that some people have nothing left at the end of the month to put into savings. Getting by on an average income isn't exactly easy, considering the high cost of housing, cars, groceries, and other everyday expenses. For example, the median national rent of about $2,000 per month is a lot for the average family to handle. In addition to these high everyday expenses, many people don't even know that they should be putting money away or how much they should be putting away. It's common to not view saving and investing as a priority, so it gets swept under the rug until the issue of a lack of saving surfaces later in life. The biggest problem with delaying the act of investing for retirement is that you're wasting critical time that could be used to exponentially grow your money. Each year that goes by that you don't at least begin to invest is a lost opportunity. Only 22% of Americans nearing retirement say they have enough money to retire. Last year, the percentage of working Americans nearing retirement who felt financially prepared to do so was 26%. This year, that number has dropped to 22%, according to Schroders' U.S. Retirement Survey. There are quite a few concerns regarding the financial aspect of retirement, and rightfully so. Inflation is a major concern, with the dollar not buying nearly as much as it used to. Large budget lines like housing and transportation have spiked. Major market downturns are also worrying. Losing 20% or 30% of your retirement savings is a real possibility. Those who don't plan on retiring for a long time shouldn't be overly concerned with such an event, but a huge loss in portfolio value for someone relying on those funds for income can be alarming. Due to these concerns, among others, 69% of working Americans plan to continue working to some extent during retirement. Most plan to continue working mainly to help cover basic living expenses, but also to stay busy and healthy. 40% of Americans plan to work until they die. Most people go to work almost every day of their life dreaming about the possibility of retirement, but a large chunk of Americans don't think they'll ever have enough money to retire at all. Instead, they think they're going to work until they die, or at least until they're too sick to do so. Now that's a pleasant thought. What will happen when working is no longer possible, but your bills still need to be paid? Move in with family members if you have that option and burden them for the remaining time? this is a terrible scenario for your remaining years. There sure are some benefits to staying in the workforce as you age. Working keeps you busy with structure and a schedule, and it means you'll enjoy your time off that much more. However, you don't want this to be your only option, and it doesn't have to be. $9,260 is the average credit card balance. The average household has nearly $10,000 in credit card debt, according to WalletHub. Consumers sometimes view purchases they make on credit as free money because it feels like you're not even spending. But credit card debt is arguably some of the worst debt a person can have because it has no collateral and the interest rates are insanely high. Incredibly high interest rates make the debt nearly impossible to pay off completely when making the minimum payment, resulting in seemingly never-ending payments. Using credit cards isn't a bad thing if you commit to paying the balance in full every single month and not buying anything you wouldn't pay cash for. The problem arises when consumers overspend and buy things they didn't need and only pay the minimum payment every month. 44% of retirees said their expenses are higher than expected. It's difficult to predict just how much money you're going to spend once you retire. One of the main reasons people inaccurately estimate how much they're going to spend is that people assume their expenses will decrease once they retire. Your lifestyle and bills aren't going to be the same as they were when you were working because you'll have ample leisure and travel time, and healthcare costs are likely to rise. On the other hand, some expenses might be lower than before, but the fact that almost half of retirees underestimated their living costs should have you sharpening your pencil. This statistic should come as no surprise because accurately determining how much you're going to spend as a retiree is perhaps the most difficult part of retirement planning. 37% haven't done any retirement planning. Having a proper plan for retirement is critical to success, but unfortunately, many people fail to plan at all. There are several reasons for this. One could be that determining how much money is needed to retire is overwhelming for those who know little to nothing about the topic. How is someone who isn't well versed in the topic supposed to know about withdrawal rates, taxes, healthcare costs, retirement account types, investment funds, average rates of returns, and more? It's also intimidating to see how large of a sum is needed to fund your income requirements. For example, someone who needs $40,000 in annual income would be shocked to find out that traditional retirement plans show them needing $1 million invested. Since many people haven't developed a specific plan for generating enough assets for retirement, it's no surprise that so many people are behind. 56% of workers expect to have less than $500,000 saved for retirement. Working Americans say that it will take about $1.1 million to retire comfortably, but most people won't have anywhere near that amount. At a glance, $500,000 seems like a lot of money, but when you take a look at the numbers, you'll realize how little it actually is. Using a 4% safe withdrawal rate, a $500,000 portfolio will only produce about $20,000 per year in income. That's hardly enough to fund a bare-bones lifestyle. About 1/4 of people expect to accumulate $1 million. So many people are behind when it comes to financial planning, but these eye-opening statistics should have you thinking carefully about your future. Thankfully, you aren't destined to be broke forever. You can avoid becoming one of these statistics by being responsible with your spending, finding ways to increase your income, and investing consistently and responsibly.